Wild swings that have been seen on Wall Street in the past couple of weeks were very much in evidence again today. The Dow was down by more than 200 points early today in trading, but ended with only a 30-point loss for the day. In a move to calm the jittery Wall Street jitters, the Federal Reserve Chairman Ben Bernanke stepped in today and threw money at the problem 3 times, totaling $38 billion, the most money funneled into the marketplace since the September 11th terrorist attack. So why did they do this? Crime Force Maureen Kelly has more.
The Fed stepped in today and injected money not once but 3 times into the financial markets to stabilize the economy. Concerns over the subprime mortgage industry has thrown the market into a loop over the past few weeks and was making it harder to borrow money, not just for homeowners, but even for businesses. This injection of cash is meant to keep the economy moving. If it seems strange that home loans are affecting Wall Street, let me explain. It used to be when a person took out a loan, it was the lender's problem if the person defaulted. There's been 2 changes. First, the rise of popularity in subprime loans. Those are loans that are made to people with poor credit or too much debt. They came into rage as the housing market took off. Defaults weren't common because the market was so hot, a person could sell before getting into trouble. Second, lenders now commonly sell those loans, bundled with other loans, to investment banks. So the person making the loan has less to lose if the borrower has a problem. Now that the market's cooled down and more people are defaulting on their loans, those investors are feeling the pinch. Cron 4's Rob Flattabo has more on how this upheaval is affecting people who are trying to get a mortgage right now.
House hunting in Santa Clara on his lunch break this afternoon. Richard Sandigo knows this is a good time to buy. The question is, will he qualify for a loan?
They're going to be a little more conservative, a little more watching, dotting the I's and crossing the T's when they do the agreements.
Still, Sandigo may have to act soon because investors are losing confidence in mortgage funds as a growing number of borrowers are defaulting on their loans. The result will almost certainly be a tightening of credit.
For the last 5 years, the mortgage companies have been just opening the floodgates and giving a lot of loans to people who maybe shouldn't have had them with no income verification, subprime lending. We're just going to go back to those basics where there's going to be a lot more monitoring, a lot more restrictions in the loan contracts.
As investors shy away from mortgage funds, Solt says lenders may simply hold more loans on the books, and they'll take a closer look at those doing the borrowing. Richard Sandigo, though, says there are 3 reasons why his loan will be approved.
1, because I'll have the 20% plus to put down. 2, my credit's reasonable or better. And I have a good track record.
In Santa Clara, Rob Flattabo, Cron 4 News.